This is a download from BFM 89.9, the business station.
Good morning, George. The Fed meets Tuesday and Wednesday to set interest rates at direction. There's a little patience panic going on right now after last year's taper tantrum. What are your interest rate expectations?
Good morning, Julian. The Fed will indicate it is no longer patient. 2, there will be no more precise indication than in the not-too-distant future. And 3, it will continue to stress its decision and is data-driven. We expect interest rates to start going up in June, no later than September. You look at this week, Julian, there's some good data coming out. 2 bits of data will be negative before Wednesday and before Yellen holds her briefing. The one that comes after will be positive. Before we have the industrial production for February, that's been hit by the weather. 2, we have housing starts in February. That comes out Tuesday morning. That also will be light given the cold weather. And 3, the Empire State and the Philly Fed Reserve surveys, they'll be coming out on Thursday after she speaks and after they give their indication. We expect manufacturing progress to have been made in March greater than expected. So we do expect there will be greater pressure to go in June unless other non-economic factors come in. But right now we're shooting for June.
Now, this strong interest rate expectation is also boosting the dollar, as well as the weakening oil is actually complicating the inflation target of 2%. Where do you see this going?
Oh, yeah, that's true. You take a look at last Friday, the PPI, the Producer Price Index that came out here in the U.S., for final demand was 0.5% lower. Profit margins were affected by, yes, gasoline, particularly in the services sector. They were squeezed. Transportation and warehousing costs are down. So, yes, there is pressure to the downside and weak profit margins overall. But overall, it won't affect the Fed rate decision as much as the confidence that we're seeing in our labor market. In terms of inflation, it is 2%. It's been that way for quite a while. There are complicating factors, but I don't think that will be the main focus as we look towards what's going to happen over the next month.
Now, going back to interest rates, the countries from China to India and South Korea to Thailand are cutting rates. Will this have any influence on the U.S. rate setting?
Yes, indeed. In fact, that may be the very item that delays the decision from June, perhaps to August or more likely September. And really, we're hoping that what's going on does not lead to a currency war and the race to the bottom. It may very well. It really depends on the perceived reason for this. If the reason is more internal, in other words, trying to develop demand, Julian, rather than external fighting other currencies, there is a chance that we will not have an all-out currency war, and that would be good in terms of the decision for the Fed to start increasing our interest rates. But this is definitely a factor that we're going to have to watch. The real pressure is going to come in just at the end of our spring, like in May. We will see how far interest rates have gone down and how many countries have continued to go that route.
Japan, of course, was one of Asia's first to start this process of massive money printing and has done very well. Interestingly, the Bank of Japan is dabbling in the stock market over there. Is the Bank of Japan establishing a support for the Japanese stock market?
Yes, indeed, Julian, and the timing is rather clear and very consistent. It has increased its buying ETFs, exchange trade funds. It's a very different direction than the U.S. Fed has done, as well as the European Central Bank has done. Both of those entities have chosen bonds over than stocks. If you take a look, 75% of their buying, Japan's central bank's buying, has occurred on days when their topics has opened lower. You take a look at this last Wednesday when the U.S. declined sharply overnight, and the topics opened down, but by the end, it closed up 1%. Traders are taking advantage. This is a wrong group to take advantage of it. It's not really focused it, but traders like Goldman Sachs, Morgan Stanley over here, and in Europe can almost rely on the fact that there will be support, and that's going to somewhat deter the results that the Japanese central bank is expecting. The main battle has been with selling pressure from retail and the weaker appetite among foreign investors. That is the area that needs to be turned around. Also, the speculation that ETF purchases could double in October due to a policy change, that may affect the demand. But again, it'll be more from a trading point of view, and we have to wait and see how it will affect the longer-term demand.
Now that sounds, yeah. Please go on. Now, that sounds like a rigged market. Do you think this will end in a bad way when they start unloading investments?
Well, it is sort of a rigged market with due respect to that term, but of course you have to look at our market and the fact that the Fed has been stabilizing the market, not directly the way the Japanese have, but we have been somewhat rigged too in that there is a support for our market that's caused by low interest rates as opposed to direct support. So yes, the ending will be very sensitive to the timing of when in the United States, when the Federal Reserve starts to raise interest rates, as perceived by the improvement in our economy, which now begins to look much stronger. And in Japan, it'll be very much perceived on where the state of the Japanese economy and demand for product, internal demand, not external, not exports. If at that point when they start to pull back, and it's not going to be soon, Julian, they're in, and it looks like it's going to be for quite some time that you can rely on their supporting the market. But when they start to pull back, if the Japanese economy is in the right direction, is strengthening, and you can see it in consumer demand internally, then the danger of a bad ending will become less. And the leverage that is being created, Julian, by the fact the Japanese have decided to support the economy through the stock market versus fixed income, the timing could be quite more sensitive than if it were through fixed income. But also, the results could be much more managed because of the fact that it's more direct. And if the economy is beginning to pick up, then I suspect that the Japanese withdrawal from the Japanese central bank's withdrawal from their stock market could be more perceived more beneficial.
Thank you. That was George Dolan, Chairman Chief Investment Officer at Lander & Fuse Capital Managers in New York.
Thank you for listening to this podcast. To find more great interviews, go to bfm.my or find us on iTunes. BFM 89.9, the business station.